What's up, class? Welcome to Startup Funding 101 Sources of Capital series, and today we're going to talk about commercial loans. I'm your teacher, Don Kavi, a serial entrepreneur and host of this channel where we talk about all things entrepreneurship and making your passion your life. If you're interested in these topics, hit the like, subscribe, and ring the bell to be the first to know when the next video drops. Let's get into it. In this series, we're going to explore several types of startup capital available for entrepreneurs and what situations they're best used for. Today, we're talking about commercial loans. The textbook definition of a commercial loan is a debt-based funding arrangement between a business and a financial institution such as a bank. How is a commercial loan different than a residential or personal loan? Commercial loans are offered to business owners to start, purchase, or finance the growth of their businesses. Residential loans are offered to homeowners to buy a house. Banks approve business loans based on the financial strength of the company and the owner's ability to earn a profit. Residential loans are approved when the homeowner is creditworthy and the value of the property is sufficient to cover the amount of the loan. When you're talking about loans, you need to think about two things: the term and the interest rate. The term is how long you'll be paying back the loan. When buying a house in the US, we typically buy property with a 30-year mortgage. Such a long time allows for a low payment. When it comes to business loans, the terms are much shorter. Depending on what you're financing, the terms can be between 5 and 15 years. If the business loan includes real estate, it can be stretched to 20 or 25 years. Interest is the rate you'll be paying back the lender above the original loan amount, called the principal. Now, do you think interest is higher on a business loan or a residential loan? In the business world, where there's risk, there's reward. Business loans are more risky than home loans, and the reward to the lender for taking on the risk is higher interest, so they will make more money. If you're used to paying 3% for a home loan, it might be 8% for a business loan. There's something called the golden rule of finance. Whoever has the gold makes the rules. This also brings up the question, if you have a business loan and the company goes under, who is responsible for paying the loan? The business? Well, and every time I've signed for a commercial loan, I've had to personally guarantee the loan. A personal guarantee means I legally promise to repay the credit issued by the banks if the company fails. Banks and lenders are almost always going to ask you for this. They're trying to lower their own risk, and like I said, whoever has the gold makes the rules. When thinking through small business funding options, business loans like this make sense when you're buying a business, a franchise, or equipment that lasts several years, and especially when it involves real estate. If you want to learn more about startup funding, I've written a free PDF linked in the description below. In the document, you'll find studies of startup companies and how they funded their launch. That's it for now. Let's keep cranking on your startup and making your passion your life. Ciao!